Picture a single farm in Iowa. One side of the property grows corn, the other side raises cattle. Same land, same owner, same season, same seven-figure loan from the same bank. And in 2026, these two halves of the exact same business are living in completely different economic universes. On the corn side, the math is brutal. The break-even price to grow a bushel of corn, covering every input, every expense, sits at roughly $5. USDA is forecasting the actual market price at just $4.20. That's not a thin margin. That's a guaranteed loss on every single bushel, before the farmer has even accounted for a bad weather year. Walk across the property to the cattle side, and it's the opposite story entirely. The U.S. cattle herd just hit its smallest size since 1951. Fewer cattle in the entire country than at any point in 75 years. Beef prices hit a record $964 a pound in April 2026. Farm-level cattle prices are up more than 11% this year alone. The rancher next door, raising the exact same kind of animal on the exact same kind of land, is having one of the best years of his career. Same farm, same year, same weather. One enterprise bleeding money, the other printing it. So how does an industry where a single property can be simultaneously failing and thriving actually make money? And what does it take to survive when the ground beneath you can shift from feast to famine with almost no warning at all? Here's the fact that shapes everything else about this industry. A corn farmer in Iowa has essentially zero control over what a bushel of corn sells for. Not limited control, zero. Corn is a commodity, which means one farmer's product is functionally identical to every other farmer's product. There's no branding advantage, no premium for quality beyond a narrow grading scale, no loyal customer base willing to pay more. The price is set globally on commodity exchanges by the total worldwide supply and total worldwide demand. And a single farm, no matter how well run, is a rounding error against that total. This is the single biggest structural difference between farming and almost every other business we've covered in this series. A shopping mall can raise rent if it improves its property. A construction company can bid smarter. A farmer growing corn can execute a flawless growing season, hit a record yield, and still watch the market price fall below what it costs to plant the crop, because millions of other farmers around the world also had a good year, and supply outran demand. And 2026 is a textbook case of exactly this trap. Corn prices have crashed roughly 50% since 2022. Soybean prices are down about 40% over the same period. Not because American farmers got worse at farming, quite the opposite. Record production, a global grain glut, and a multi-year trade dispute that kept China, traditionally the largest buyer of American soybeans, out of the market for an extended stretch, all combined to flood the world with more grain than it currently wants to buy at a price that keeps farmers solvent. Here's the part that makes the commodity trap so dangerous. While the selling price is entirely outside of farmers' control, the cost side keeps climbing regardless. Seed, fertilizer, and chemicals represent one of the largest input costs on a modern industrial farm, and none of them are optional. Skip fertilizer and yields collapse. Skip pest control and an entire field can be lost to a single bad month. Fuel and equipment costs follow the same logic as the heavy machinery we've seen anchor other capital-intensive industries. A modern combine harvester can cost several $100,000, and like a container ship or a drilling rig, it costs money whether it's running or sitting idle in a shed. Land itself is often the single largest expense, whether purchased outright or rented, and land isn't a cost that scales down when prices fall. A farmer still owes the same mortgage payment or the same cash rent to a landlord regardless of whether corn sells for $4 or $7 a bushel. Then there's labor, increasingly specialized and increasingly expensive as fewer people choose farming as a career, and financing costs, which in 2026 have become one of the fastest growing expenses in the entire sector. U.S. farm sector debt is forecast to hit a record $624.7 billion this year, with interest payments alone reaching roughly $30 billion, which works out to about $90 million in interest industry-wide every single day. That's not a number that responds to a bad harvest. It's owed whether the crop fails or not. Put those two forces together, a selling price the farmer can't influence and a cost base that keeps rising regardless of that price, and you get the defining condition of American agriculture in 2026, an industry where doing everything right can still end in a loss.
If commodity pricing is the risk a farmer can't control from the market side, weather is the risk they can't control from the production side. And unlike a factory that can adjust output when demand shifts, a farm has exactly one shot per crop per year. Plant too early and a late frost can wipe out germinating seedlings. A dry spell during the critical pollination window can cut corn yields dramatically, no matter how well the field was managed up to that point. A single hailstorm at the wrong moment can destroy a field that looked perfect the day before. And because most row crops only get one growing season per year, there's no way to make up for a bad stretch the way a retailer might recover from a slow month with a strong one right after. A ruined crop simply means a full year of invested capital, seed, fertilizer, fuel, labor, land costs, producing little or nothing to sell. This is exactly why crop insurance has become such a central pillar of how American farming actually functions financially. For 2026, USDA's Risk Management Agency has finalized revenue guarantees for corn, soybeans, and wheat based on projected prices, essentially a financial backstop that pays out if either yield or price falls below a guaranteed threshold. It's not a luxury. For many operations, it's the difference between surviving a bad year and losing the farm entirely, because unlike almost any other industry, a farm's core physical input, the weather over its own specific acres, is completely outside anyone's control, and the insurance market has effectively become the mechanism that keeps outside capital willing to keep lending into an industry this exposed. Livestock operations face a version of the same uncertainty, but stretched across a much longer timeline, which is exactly what's driving the dramatic beef prices we opened this video with. Rebuilding a cattle herd isn't like restocking a warehouse. A rancher who decides today to expand their herd is making a bet that won't pay off for years. A calf takes roughly 9 months to be born, then years more before that animal is ready for slaughter, or before a heifer is old enough to start producing calves of her own. That means the entire industry is trapped in what's known as the cattle cycle, a slow-motion boom and bust pattern that can take the better part of a decade to complete one full swing. Right now, the U.S. is deep in the contraction phase. The national herd fell to 86.2 million head as of January 2026, down from roughly 94.7 million in 2019, and the lowest count since 1951. Years of drought pushed up the cost of feed and water to the point where many ranchers made the difficult choice to sell off breeding stock rather than keep paying to maintain it, which shrinks the herd today and guarantees fewer calves for years into the future. On top of that, restrictions tied to New World screwworm have kept the border with Mexico closed to imported cattle, cutting off a supply of roughly 1.2 to 1.5 million head that normally flows into American feedlots each year. Here's the twist that makes this genuinely strange. The same scarcity that's devastating to a farmer trying to expand their herd is extraordinarily profitable for a rancher who already has cattle to sell. Tight supply against strong consumer demand has pushed both cattle prices and beef prices to record highs, and industry forecasters don't expect the herd to meaningfully rebuild before 2028 at the earliest. A single decision made years ago, how many cows to keep during the last drought, is still determining who's profitable and who isn't today. In this industry, the consequences of a bad year don't show up next quarter, they show up for the rest of the decade.
There's one more piece of this industry's financial structure that makes it fundamentally different from anything else in this series. Government support isn't a side benefit. For a huge share of American row crop farms, it's the difference between profit and loss. USDA is forecasting that direct government payments will reach roughly $44.3 billion in 2026, expected to make up close to 29% of net farm income for the year. Strip that support out of the picture entirely, and net farm income for the sector would fall by nearly 12%, from a forecast $153.4 billion down to roughly $109.1 billion. In other words, without government payments, a meaningful share of what looks like industry profit on paper simply wouldn't exist. This isn't a new phenomenon born out of 2026's specific problems. Support programs like crop insurance subsidies, price loss coverage, and agriculture risk coverage have underpinned American farm income for decades. But the scale of reliance has grown sharply as market-based income has weakened for 4 consecutive years running. And there's a political dimension layered directly into the commodity price story we opened with. A trade agreement reached after an October 2025 summit committed China to purchasing 25 million tons of American soybeans annually through 2028. But by the end of June 2026, actual new crop bookings sat at just 200,000 tons, less than 1% of that annual commitment, before a single massive one-day purchase of 472,000 tons finally moved the needle in July. A farmer's balance sheet in 2026 doesn't just depend on rain and fertilizer prices. It depends on the outcome of trade negotiations conducted thousands of miles away by people the farmer has never met. All of these forces together are producing a level of financial distress that industry analysts are now describing in stark terms. Chapter 12 farm bankruptcy filings jumped 46% in 2025 to 315 cases, the highest level since 2020, with the Midwest and Southeast accounting for the majority, and Arkansas recording its highest filing count of the entire century. And that official number almost certainly understates the real scale of the problem. Chapter 12 bankruptcy protection requires that most of a household's income come from farming, which excludes many financially struggling families who hold off-farm jobs to make ends meet, meaning their operations simply close or sell off land quietly, never appearing in the bankruptcy statistics at all. More than 160,000 American farms shut down entirely between 2017 and 2024. The American Farm Bureau Federation has started using the phrase generational downturn to describe what's happening, a warning that this isn't a single bad season, but a multi-year erosion that's reshaping who can afford to stay in this business at all. Given a business with no pricing power, weather that can erase a year's revenue in an afternoon, cycles that take a decade to turn, and profitability that depends partly on government checks and foreign trade deals, how does anyone actually survive running a farm long-term? The first strategy is diversification across multiple commodities, exactly like the farm we opened this video with. A farmer running both crops and livestock isn't doing it by accident. Different commodities often move through their price cycles at different times, so losses in corn can be partially offset by strength in cattle, even on the very same balance sheet. The second strategy is aggressive use of crop insurance and futures market hedging. Rather than simply hoping the market price stays favorable, sophisticated operations lock in prices months in advance through futures contracts, trading some potential upside for protection against catastrophic downside. The same instinct that pushes an airline to hedge fuel costs or a shipping line to lock in long-term freight contracts. The third strategy is scale. Larger industrial farming operations can spread fixed costs like equipment and land improvements across more acres or more head of cattle, giving them thinner per unit costs than a smaller operation carrying the same debt load on far less production to sell against it. Part of why the industry has consolidated so heavily, with smaller family farms increasingly squeezed out by operations large enough to absorb a bad year. The fourth strategy is treating government programs and export relationships not as background noise, but as core parts of the business plan, actively tracking trade negotiations, enrollment deadlines for support programs, and insurance selections with the same seriousness as planting decisions, because in 2026, a policy announcement in Washington or Beijing can move a farm's bottom line more than a good or bad week of weather.
Return to that one farm we opened with. Corn on one side, losing money on every bushel, cattle on the other side riding the best prices in decades, both halves owned by the same person, financed by the same debt, exposed to the same unpredictable sky overhead. That split isn't an anomaly. It's the accurate picture of American industrial farming in 2026, an industry where the selling price is set by a global market no single farmer can influence, where a single afternoon of bad weather can erase a year of work, where a cattle decision made during a drought years ago is still shaping profits today, and where nearly a third of the industry's income now comes not from selling anything, but from a government check. Industrial farming doesn't make money by controlling its market, because it can't. It survives by managing everything it can control tightly enough: costs, insurance, diversification, timing, to stay standing through the years the market and the weather refuse to cooperate, waiting for the cycle to eventually turn back in its favor. If you had to bet on it, does the American cattle herd finally start rebuilding by 2028 as forecasters expect? Or does another drought or disease outbreak push that timeline out even further? Leave your prediction in the comments. And if you want to see what happens after the harvest, how a bushel of corn or a side of beef actually travels from that Iowa farm to a grocery store shelf, and exactly where the real margin gets captured along the way, that's the story the next video in this series is going to tell.